All right, guys, let's get going. What is it? Well, let's wait another couple minutes. Only 3:01. You guys are on time. Thanks so much. Who's in? Did I see somebody in Tel Aviv? Chris Miller, how are you? Levy, how are you? Leo, how are you? Leo, Leo Kingston is on here. Oh, now I'm nervous. I'm nervous now, Leo. Do you see what you did? I'm nervous, Leo. Leo drives Ferraris. That's what Leo does for fun, among other things. Leo does a lot of things
It's
for
a
fun.
fun habit.
Yeah, Leo does a lot of things. Gabe, Gabe DeSaverio, how are you? All right, guys, let's get going. So a couple of days ago, I posted a little thing, said, if I was going to do a Facebook Live and talk to you about syndication and things, how many of you would show up? I was just floored by how many people said they would show up. So here we are. This is Sam Grooms. He's my partner in this syndication thing, right? Do a thing. My name is Ben Leybovich. And we're happy to be here because syndication really is kind of a black bag. A lot of people have a lot of questions. There's not a lot of answers simply because you can make a lot of money here. And, people who know what's going on don't necessarily want to forward the information to you. So let's see if we can clear some of this up. Understand, we're going to skim over the tops of the trees here. It's 1 hour presentation or whatever. We'll stay longer if we need to stay longer. But please understand, we can't really go in depth on basically anything because for that we need spreadsheets, and there's not going to be spreadsheets here, at least not today, especially not today, I guess, because I don't know how to work that so that I can reverse my computer screen because I'm not that computer literate. That's what I have this guy for. Okay, but having said that, let's get going. And I actually took some notes because I invited you guys to Joe, how are you? Joe, how are you? Mark Forrest is here. Nestus, how are you? I invited you guys to ask some questions on that previous thread. And some of you did, and I took some notes. So if I do look down, it's because I have this sheet of paper with some of your questions in here because I wasn't sure how I'll be able to switch from one tab to the other. So we're going to start in the beginning, and we're just going to make our way forward, and we're going to start with, like a funnel, very big concepts, and then gradually narrow things down a little bit as much as possible. Tiffany, how are you? So Tiffany, speaking of Tiffany Alexi, Tiffany asks, what's a good syndication deal? And, girls are like that. They go straight to the core of the thing and ask you a question you could never possibly answer in an hour Facebook Live. But let's see what we can do, Sam. So if I may I?
And before we get started, if you guys have any questions, feel free to type them in the chat box, and I'll try and keep a log of questions, and we can add them to our list at the end.
Heather Turner, how are you? Aaron Mazzarella, how are you? Okay, so kind of a big concept, like what's a good syndication? I don't know if it's appropriate to say what's a good deal, period. And just the way I see what a good deal is ability to stay in or multiple exits to get, I shouldn't say or, and. What makes a good deal so difficult is that it has to be both. It has to allow you to stay in long term should you desire to do that, but it has to also have multiple exits, all of which make you money. So very globally, what does a good deal mean? That's what it means. You will make money if you stay in. You will make money if you get out at this point. You'll make money if you get out at this point. You'll make money if you get out at this point. The process of underwriting this stuff and the process of like, okay, this is the one I want to pull the trigger on, is finding the thing that fits all of the boxes. Meaning you can stay in if you want. You can get out in 18 months because there's a business plan to support that. You can get out in 24 months because there's a different business plan to support that. You can get out in 3 years, and 5 years, and 10 years. Do you understand what I'm saying? So it's very difficult to quantify what is a good deal without really walking you through the entire spreadsheet. But globally speaking, that, in my mind, that is what constitutes a good deal.
So I think what you need to know is, to have this good syndication deal, you need a good deal. And this is one of the criteria is to have a good deal, is you need multiple exits.
Absolutely. And, syndication doesn't really exist in the world of bad deals. I mean, maybe it does in somebody's world, but I don't know how to raise money for a bad deal. So we have to just be separate those issues. We have to be talking about what's a good deal. Adam is asking, why is Ben so abrasive? Adam, I don't know. You have to ask Darren Sager, who's not here right now. But, that's his bag. I don't know. I don't know what he even means by that. Are you blaming
Darren for you being abrasive?
No, he tells me I'm abrasive, so he must know. Okay, let me see. I took some other notes. Okay, a good deal. A healthy balance of cash flow and appreciation. So this is me being abrasive. It's very sexy to talk about how cash flow is king. Isn't it romantic? Sounds so romantic, right?
You're so romantic.
Cash flow is king, and appreciation is just an added bonus. And that's a bunch of bullshit. It just is. I'm sorry, guys. The metrics that are really important don't work without appreciation. Okay? Now, I think it's important to stress that we don't mean appreciation in the sense of getting lucky and the tide is coming in and it's raising our ships and it raises us along with everybody else. When we say appreciation, we mean what's called value add.
Forced appreciation.
Forced appreciation. So engineered appreciation, a business plan whereby the property is going to be worth more after you've done whatever you're going to do than it was before you did what you're going to do. Okay? But you absolutely need forced appreciation. You absolutely need the back end appreciation.
But cash flow does give you staying power. So cash flow, you either need to have cash flow or you need to be well capitalized to have staying power until you can finish that forced appreciation.
This is very true. And it could also be said that because we're talking about multifamily, let's take a step back. In multifamily, if I was going to ask you guys, how do you determine value? Of course, every single one of you that have read articles on Bigger Pockets, that have been around this for a while, every single one of you would say, well, yeah, you capitalize the net operating income, right? So yes, the focus is on the income, but with one eye on the value. So take yourself back and understand, if I want higher value, which I do because I want to be rich, and that's what makes you rich. If I want higher value, do I not need to focus on the income? So any conversation that segregates income from valuation in multifamily is just stupid. In multifamily, you can't separate those two things. Having said that, I think it's important for people to understand, specific to syndication, if you're going to raise money, the first question people are going to ask you is, how much profit are you going to make me? And the second question, immediately following, how soon can I have my investment back? So people want to know how much money is going to be made and how quickly they can de-risk, how quickly they can take money off the table. Well, when you start talking about taking money off the table, liquidating via refinance or a sale or whatever, because you're not paying those people back with cash flow. It's just not possible. I shouldn't say not possible. Very seldom is it possible. So if you're going to give people a portion or all of their investment back, guess what you need for that? Whether you sell or you leverage, you need appreciation of equity, because then you pull that equity out to give people their money back, right?
Yep.
So any conversation that we're buying a cash flow investment is just silly. There has to be cash flow because it's a function of the model. But what we're buying is an appreciating, hopefully, asset. Because if it's an asset that doesn't appreciate, we don't have an exit. And if we don't have an exit, why are we buying it? And I could talk about this for about 3 hours. Having been in real estate for a decade, I kind of have put cash flow in perspective for myself. And I think that most people who have been around for a while understand exactly what I mean by that and what I'm saying. By the way, guys, I want to take a minute and ask you right now if you would share this. We have quite a few of you on this video. It looks like 27, 30, fluctuates, but want to spread the word. So if you wouldn't mind sharing this and helping us get some people on this podcast or this Facebook Live, that'd be great. But Tiffany, hopefully this answers your question. Mark Forrest, kind of similar question along the same lines of how do you underwrite a multifamily deal? Well, you know, I know I'm going to sound cryptic, but it's not a cash flow investment. Cash flow has to be there to collateralize equity, but it's not a cash flow investment. So it cannot be analyzed strictly from a cash flow point of view and cash flow frame of mind. So what we need to do is underwrite all of the cash flows, including to plan our exit and disposition and refinance and all the waterfalls, and underwrite to what's called the internal rate of return, which of course takes all of that and puts it together and kind of spits out a time adjusted to a certain extent in today's dollars rate of return, which we call IRR.
And IRR is what you use to compare when someone asks, what's a good syndication deal? When you get a bunch of different deals, that's what you'll use to compare one deal to the other. Most people will underwrite to the IRR. So it's a good metric to.
Well, I don't know if most people do. That's a lot of people underwrite to the cash on cash. A lot of other people underwrite to cumulative cash on cash. The thing is, you guys know this, right? If you get $100 today, which constitutes a 10% rate of return on $1,000 invested. So today you get $100. 10 years from now, the same $1,000 investment returned at 10% will still give you $100. But I don't have to tell you that because of inflation, because of lost opportunity cost, because of net present value is not the same of that $100. So I keep harping on people and I keep yelling at people, don't underwrite percentages. Percentages aren't dollars. When you start thinking about things in terms of dollars, both income, expenses, and return investment, when you start thinking about things in terms of dollars, you understand I've got $100 today and I've got $100 10 years from now. It doesn't buy the same thing. It's not worth the same amount. So if you're going to be completely intellectually honest about this, you have to acknowledge that $100 tomorrow doesn't buy the same thing as it buys today. So how do you boil it down to a rate of return that pegs it on net present value or discounts it to net present value? And obviously IRR, XIRR, MIRR. I mean, there's variations, but that's basically the.
So it basically distinguishes between the timing of those cash flows, the cash inflows and outflows. And
he's a CPA. He's a CPA. He thinks in terms of spreadsheets. It's like the vibrations inside there are so strong, they make his hair just jump off his head. It's amazing.
There's a lot of vibrations.
It's a lot of vibrations. Okay.
Let's Peggy just joined. I thought she couldn't join today.
Oh, yeah. Yep. Hi, Peggy. Gary Berstevetsky, how are you? Okay, moving along. And Mark, I don't know if I answered your question well enough, how you underwrite, but you have to underwrite all of the cash flows, which means you have to project to the best of your capacity all of the cash flows. And then you have to kind of run them through this discount model to kind of do an apples to apples comparison. And that's basically IRR underwriting. I don't know that I can do any more detailed explanation in a forum such as this. Okay, Jeff Bush, investment metric hurdles. You want to take this?
Yeah, so that takes us back to the IRR conversation. So one of the biggest hurdles people will look at is like, say, a 14% IRR on a 10-year hold. That's the minimum we write to. We also look at 5-year and 3-year metrics, but at a minimum, we want to get 14% IRR on a 10-year hold. We also look at 10% cash on cash, average cash on cash for the hold period.
And that's strictly on cash flow. That's without the final
Right.
appreciation built into that.
No capital event there, just cash flow from operations.
Right. And the reason you're looking for that 14 to 14.5% IRR is because it's hard to raise money from partners for anything lower than that. It's just not attractive enough. So in other words, people who have the education and have succeeded financially enough in life to be able to deploy money into a syndication, they have some options. And those options preclude you being able to be competitive at something much lower than 14% IRR on a 10-year hold. Now, we should discuss why 10-year hold. I mean, a lot of people still, I guess, underwrite to a 5-year hold. I would be nervous to underwrite a 5-year hold.
It's very risky the shorter time frame you have because you don't know where the market's headed. We do a 10-year hold because if the market takes a dive, it's going to be recovered by 10 years. I mean, every recovery we've seen has happened within 10 years of the downturn. So we do a 10-year hold just if next year the market takes a tank, we have the ability to hold through the recovery of that.
Right.
Now, we don't necessarily want to hold it for 10 years, but we feel it's our fiduciary duty to underwrite for 10 years.
Right. And so, if you take an investment that looks like a 14% IRR in a 10-year hold, on a 5-year hold, that same investment might look like 17 to 18%. On a 3-year hold, it might look like mid 20% IRR. So it's important to know apples to apples what we're talking about. But the whole point of trying to underwrite 10 years is it's just a safety feature because we're late in the cycle. And so you kind of want to make sure that I know I want to get out here, but just in case I can't, what's it going to look like for me to stay in this thing that long? Right. You have to be able to understand that. Okay.
And I want to address Mark's question that's on here real quick. So he says, how do you underwrite if you don't plan on selling? So what we're talking about is syndication metrics and how to underwrite syndication deals.
Yes and no.
Yeah.
Because I think it's very wrong to not plan to sell. Unless you're buying what can only be described as an heirloom asset. Something sitting on a cliff overlooking the ocean in the state of California that is never going to do anything but appreciate. It's never, what those assets are. Unless you're talking about that A+++ quality asset, you're gonna sell it. Because here's what happens if you don't. If you don't have appreciation, let me give you a simpler example. Okay, there's two guys. They both bought an investment. One of them bought this investment in some place, God forbid, Ohio, like Lima or Toledo or Cleveland or Indianapolis or whatever. Okay, paid $73,000 for it. Another one bought the same investment in Austin or in Phoenix or in California or someplace where the people want to live. So the guy that bought it for $73,000 in Ohio, Indiana, or Michigan is very likely going to be sitting on an asset that's still worth $73,000 or very close to it. The guy that bought the same $73,000 asset, but in a place where people want to live, he's probably looking at a $200,000 asset. So the problem is, eventually both of these houses are going to need a new roof. And they're both going to need a furnace. And they're both going to need some flooring and some plumbing and new windows. So how are you going to feel stroking that check for that $73,000 house that you bought for 73 that has intrinsic value of 73 and thus is still worth 73. How are you going to feel stroking that $25,000 check on that house that you're never getting back? Versus if you know your house is located because of what it is, where it is, it's appreciated, and chances are it's going to continue to appreciate. Fine, you'll stroke a check. It's going to hurt for a second. You'll cry for a minute, but then you'll be okay because you know you'll get your money back. So the entire notion that because it's not a syndication, I don't have to worry about selling, I don't have to worry about appreciation, because that's what you are telling me. Because you don't have to worry about selling it, all of a sudden you don't have to worry about appreciation. No, that's wrong. You have to worry about appreciation. Otherwise, you end up being in a place where you're stroking good checks after bad money.
You can still underwrite to a cash on cash and then assume an appreciation. You just won't be able to use the IRR model in that case, to answer your question. And Dan
take it easy in Ohio.
Dan says take it easy.
Well, I came from Ohio. I still have stuff in Ohio. Yeah, it is what it is, dude. I mean, it's like it is what it is. But there's a reason I moved, and that's the same reason other people move. And there's a reason I buy here in Phoenix as opposed to Ohio now, and that's the reason a lot of other people want to buy in Phoenix as opposed to Ohio. I'm just telling you the truth. I can only tell you what I know, and this is what I know. Okay. Who's up? Investment hurdles. Interesting. Adam is asking, to you, how long is too long to hold a syndication and why? You hold the syndication until the investment is maximized. And once it's maximized, if you hold any longer, then you're on the back end of that slope. So why would you, right? So ideally, your business plan will tell you at what point you've hit the hurdle where your investment is maximized. And at that point, don't get greedy and sell it. Okay. Grant Warrington asked, what returns are investors looking for? I think Sam covered it, about 14.5 to the partners after all of the expenses, fees, and everything else. About 14 to 14.5, 14.75, 14.25. I mean, you're guessing at everything essentially here because nobody has a crystal ball, right? But in having said that, we have to make certain assumptions, right? And that's kind of, can our assumptions lead us to that kind of hurdle? About 14 to 14.5% IRR. Seems to be the going rate. Chris Simmons asked about hurdles, prefs, and payout methods. Well, we talked about the 14.5% IRR, or as close to it as you can get, with a reasonable cash on cash. Another hurdle is really the value add, because you're not getting anywhere near 14% IRR without value add. And so I would say probably cumulatively between burning through the economic losses and then the value add, you're probably looking at least $350 to $400 a door of value add, right? In order to get there. What else? Daniel, how to present a deal to investors?
So when you get a deal from a broker, you're getting what's called an offering memorandum. You're going to want to create something similar to that to give to investors so they can know what the deal is going to look like. Some people call it a prospectus, and an offering memorandum, an investment summary, some kind of 10-page to 30-page summary of the deal. I guess when you're getting 30 pages, it's no longer a summary, is it? You're going to present it through emails, over the phone. A webinar is really popular to present to investors. However you're best comfortable conveying that information. And
you got to be careful with the webinar, right? Because regulation, depending on which you do, right? You got to be careful. You can't market yourself in most of these cases to people that you don't know.
Yeah, it wouldn't be a Facebook Live.
It would be a webinar by personal invitation because you have personal relationships and connections with these people, and somehow or other, for some reason. But don't think of it as, you're going to plaster this webinar all over Facebook and advertise an investment return. And by the way, we're talking about returns. We're talking about projections. I tried to allude to this before. We can't guarantee returns. You have to be an FDIC insured institution to be able to guarantee the returns. Nobody can guarantee a return. So if you see anybody anywhere dealing with real estate investments outside of a REIT, for instance, guaranteeing anything, just run the other way. That's kind of like my opinion. You agree? Yeah. Okay, how to find deals. Lucas Miller wants to know how to find deals. If I knew, I'd tell you. It's hard to find deals. I will tell you that probably relationships, and more relationships. Sam and I, between the two of us, probably get about 50 emails per day, every day, with most days, with deals sent to us. But that's just because we are on these guys' email lists, just like everybody else, and we get the same deals that everybody else. Now, once you make those relationships, and once you begin to be known as somebody who performed, you do get your eyes on some stuff that's off market, that's not listed, that's not being disseminated publicly, but that doesn't mean it's good. Just because it's not listed doesn't mean that it's an opportunity. Lucas Miller says, you're always talking about how you're underwriting.
Lucas, that just means you haven't talked to enough brokers yet. Like Ben just said, we get 30 deals a day. I would say from 10 different brokers. So you just need to start talking to more brokers and get on their list.
Yeah. National brokers, everybody. I think Sam and I agree. We're of the opinion that, we don't need to do one after the other. We kind of like this market in Phoenix. We understand this market. We know this market. We have relationships with people in this market. And so, whenever it happens, it happens. We don't need to be floating a PPM every 2 months, something like this. But we still do underwrite a lot nationwide. We do have a few markets we'll look at. How to find investors. Guy Levy says, how to find investors. I have an answer for you. And it's a bit cryptic, but it's the best I can do. You don't find investors. They find you. That's the key. You have to position yourself in such a way so as to allow people to find you. Not only is it the only thing you can really do, but it's the only thing that is legal to do. Again, because you are not allowed to advertise publicly to people. You can't do that. And so this is a situation where somebody needs to be reaching out to you and asking you about your investments and what you've got going on, and suggesting to you that maybe they're interested in taking part based on what they see from you. But it's a circumstance whereby they have to be reaching out to you. You can't look for them.
Well, that's the sustainable model long term. If you're talking about immediate right now, what do I look for investors? You need
mom and dad.
Yeah, look at family, friends, and colleagues. And if you don't have the investors in that circle, you're going to probably need to partner with someone. Sustainable long term, you're going to have to do what Ben says. You're going to need to have some way for investors to find you instead of you going out and finding them.
Yep. Okay. Chris Simmons, how do I divide membership among local and passive investors? So I think what you mean by that, Sam and I were talking, we're not sure. Local? What do you mean local? So if what you mean is how do you divide membership between limited partners and general partners, and you are assuming that general partners have to be local, no, they don't have to be. We could buy a deal anywhere in Columbus, Ohio, and we could be general partners, and we don't have to be local to Columbus, Ohio. But how do you divide it? I mean, it's all over the board because this is very inefficient. It's all over the board, but I think you'll find it difficult to be asking people for any more than 30% on the cash flow split and the back end split. If you do any more than that, I think you'll find, maybe some pushback. But anywhere between 20 and 30% is what I see people do. People also, most of the time, will do a preferred rate of return.
Right. So you can see usually an 8% preferred rate.
Yeah, between 7 and 8. And, this is a little bit in the woods, maybe too much in the woods, but when we say preferred, we're not allowed to guarantee return. So we're not guaranteeing the return, but we are guaranteeing that the first 7 or 8% that comes in goes to you, the investor. We guarantee you that. We're not going to take anything out of the cash flow as the general partner until you get your 8%. Now, from there, the 8% can either be a simple 8% or what's called cumulative 8%. And cumulative is something that, if you made 6% this year and you owed somebody 8%, well, that delta of 2% gets rolled onto the next year. So in the second year, now you owe 10% as opposed to 8%. And so you play that catch-up game until they're totally caught up with 8%. Carl, how are you? How about using a licensed broker? Yeah, we can use a securities broker. A securities broker can raise money for the deal, yeah. I don't know the details of that. I've not done that. But what I think would happen, Carl, is that the broker, in order to get paid, would have to get paid out of their clients' proceeds.
Yep.
And so you have to ask, are those clients going to be willing to, essentially lose a portion of your investment to the broker?
And you're going to have a hard time doing that on your first deal. They're going to want some kind of track record before they take their clients and put them in your deal.
Right. Daniel says, fine, the deal and the money will follow. No, that's a bunch of shit. It doesn't work. I see Sam is laughing. Now, if Sam is laughing, if he's smirking, you said some real funny shit, because this guy doesn't have a sense of humor. Like, there's numbers running around inside that skull. There's numbers. There's no humor. There's just numbers, right? Talk to his wife. She'll tell you. She'll back me. So if he's laughing, that's funny. That's funny. Money doesn't come just because the deal is good. That's a lie. Money doesn't come just because the deal is good.
Daniel thinks that's funny too.
Yeah. Okay. Talked about how to find investors. Chris Simmons.
I was talking about splits too. Sometimes you'll see hurdles. So it'll start out at 20/80. Then after you get to, say, a 15% return, it'll jump up to a 70/30. Then after it hits a 20% return, then you'll get a 60/40 split. So, and those can be good, so that incentivizes the sponsor, the general partnership, to continually increase those returns because they get a bigger share of all those future dollars.
Right. Next, Daniel Janis asks, how do you build a team for management and renovations? I don't think you do. This doesn't translate very well to multifamily. You hire a property management company with a construction arm, with a legal department, reporting department, accounting department, and they facilitate this entire process for you. Now the trick is that it takes a certain magnitude of a deal in order to be able to absorb the overhead associated with such a PM. Most importantly, I think it's a function of payroll. Because in order, for that professional management infrastructure, what you're talking about, hire mercenary, what you're talking about is, here you have this property. At the level of the property, you have the payroll personnel. Then you have the regional who is responsible for your property and a bunch of other properties. Then that regional reports to the headquarters. At the headquarters, they have the legal, the accounting, okay? So you're paying a management fee to accommodate that big overhead, but you're also paying payroll. They're their employees, but they're passing the cost of these employees on to us. So we're paying for them. So it requires a certain magnitude of a project before a truly professional PM that has all of those handles in place and all of that infrastructure would be attracted to your deal. It's like things haven't changed since the days of CFFU. It's not you, it's what you bought. What you bought attracts tenants. What you bought attracts investors. What you bought attracts lenders. What you bought attracts the PM. It's what you've bought. If you bought the wrong thing, good luck convincing people to finance it, to invest in it, to manage it, and to live in it. All of that gets hard when you buy the wrong kind of asset.
And most PMs now have, like Ben said, a construction arm. If you are in a city where maybe there isn't a big PM that has a huge construction arm, we're starting to see companies pop up that just do apartment renovations. We saw one at an event we were at last week. I think it was Urban Complex here in Arizona. I think they might be in California too, where that's all they did is big apartment renovations. They can do 100 a month if they need to. So,
okay. Guys, do you have any other questions? I'm going to move on to this next one I've got. My first syndication deal fell out of closing about 4 days before closing. I lost some money on it. So watch out for that. Don't let that happen to you. And that's all I'm going to say about it.
As for deals that actually closed, my advice would be, like we just talked about, hire professionals. Don't try to do too much yourself. Hire professionals, whether that's a mortgage broker. That's what they do for a living. They close loans. They will get it closed for you. They're worth the 1.5% fee, 1%, whatever it is.
Absolutely.
Are you liking confidence?
Yeah. All right. Ginny Park. Okay. How does one know when you're ready to use other people's money? So in other words, how do you know? That's a really good question. I don't know if it's a function of me getting older or more experienced or more afraid or, more whatever. But it's a load to carry. I mean, that's as simple as it is. It's a load to carry. It keeps me up at night, and that's why there's no guarantees in anything, but I will only do the very best deals I can possibly find. I'd rather not do a deal. That's my perspective. And the fact of it is that, and this has to be talked about, and it's not remiss on investors. There's a fair amount of moral hazard in what we do, because on the one hand, I'm sitting there for 6 hours a day underwriting deals. And I do that without pay until one closes. But when one does close, I get paid for putting that together. But that payment comes before the investment returns come in. But if I didn't get paid for the last 4 months or 6 months of underwriting deals, I couldn't afford to be doing it. So I'm creating this opportunity for everybody, myself, all of the investors, but reasonable people understand I need to get paid for it. But I need to understand that I am getting paid a fee for putting something together before the investment returns have come back. There's a fair amount of moral hazard involved with it because, those fees can be quite substantial, and you can get, carried away with just doing deals to get paid for doing deals. And that moral hazard I take very seriously. I mean, it's definitely there. To ignore it is just stupid. It's definitely there. We all want to get paid, and this is hard work. What we do, what Sam and I do. So why shouldn't we get paid? On the one hand, on the other hand, there's that moral hazard. So
as an investor, I think it's one of your responsibilities to push back on the investor on things like assumptions to make sure it's an actually good deal, and they're not just trying to push a deal through to get an acquisition fee. And we don't feel bad when we get questioned by investors.
And not everybody subscribes. It's like, this last one we raised $3.5 million. Look, half of the people we talked to didn't play along. And that's okay. It's not for everybody. And I'm not there to convince you why it's a good deal. That's a recipe for disaster. If you don't want to play along, I think it's best if you don't play along. And whether this moral hazard was the reason you didn't play along or not, I don't even know. That's beside the point. The point is, if you want to raise $3.5 million to close the deal, you better raise like 7 or 8 so you can be sure to close the deal. But a lot of people aren't going to, in the end, come into the deal. Be aware of that. But the original question of how do you know? I don't know how to answer that, because it keeps me up at night. It's a scary proposition. You are managing essentially a lot of people's money, and it's very real. So it's, I don't know, I guess. That's all I can say is, when you're ready,
Yep. I have some other questions that we've gotten in.
Cool.
So from William, he said, how do we determine the exit cap rate?
We spit in the air and see which way the stream of air carries it. Well, there's 3 ways to do it. Now, I'm not going to tell you exactly how we do it, but I am going to tell you there's 3 ways to do it. One way is to just completely ignore it and to say, well, shit, I don't know, so I'll just use today's cap rate.
Hint, that's the wrong one.
But it's compelling because, hey, listen, if the economic cycle is a cycle, if it's a sine wave, and you happen to be right now at this place in the cycle, is it really that unreasonable to think, okay, I don't know how long the amplitude is going to take. I don't know if it's going to be like this or it's going to take forever long, but eventually the sine wave will return to the same place where I'm at right now. So I'm going to plan on staying in the deal long enough to experience that return to a similar circumstance that we have now.
But if you're at historic lows or historic high interest rates, you probably shouldn't do that.
Right. And so that's probably where that logic is wrong. And we have a lot of money that's been put into the economy. There's a lot of money chasing yield. There's national, considerations for bonds, both in the US and Japan, you name it, people that study it who are a lot smarter than we are. There's a lot involved. So, the second variation of this is to say, okay, the interest rates are going to go up. That's it. Let's just pick a number. And then the third way, and we're not going to talk about that because it's a long conversation and I don't want to get into the whole nitty-gritty explanation, but the third way is to actually have some kind of logic and reason why you pick a certain inflation delta on your cap rate. But that's essentially what we do. Is there's logic involved, and if you agree with it, fine. If you disagree with it, fine. But this is what, according to the best ability to understand the economists and what they're saying, kind of, I don't want to say the words predict because nobody can predict, right?
Well, if you know how much interest rates are expected to go up, you can add that, say, to your cap rate, and assuming cap rates and interest rates just go up evenly, then you have a pretty good predictor. Now, we've had interest rates rise over the last year and cap rates haven't started rising. So that would be a very conservative model to use.
And, in this environment, it's easy to say, hey, people are just being stupid and irrational. On the other hand, when you read about shortage of housing because people haven't built anything for 5 years during the crash, and the population is just growing, and all these things are happening, but there's an incredible shortage of housing all across America, then you start wondering why people are bullish on housing, So it's a long conversation, but probably better say for some other time. Do you have?
William also asked about waterfall splits. We kind of covered that already for him. Roman asked, how do we filter out overpriced deals? Is there an easy filter that we use? You have to know your market. So we got sent a deal today. It was a 200 and something unit. They wanted 115 per unit, and we know that that's overpriced. You have to know your market. You have to know what the rents are for that property, what they could be, and that's the easy way to filter out, so you don't have to get in a full underwriting.
And the fact that it's 115 per door is not why it's overpriced.
No, it's that compared to the rent.
It's that we know that here's going to be the economic loss on the current rents. Here's what we think the delta in rents is going to be. Cumulatively, does that give us enough to achieve the IRR we want if we pay 115? No, it does not, because we kind of know those relationships. We kind of know those numbers. And so that's one that just goes into the trash bin.
But until you get to that point where you know that, you're going to need to underwrite every deal. You're going to need to look at those deals. And that actually helps you. That helps you get a better understanding of your market. So I would recommend starting out, just underwrite everything fully.
And that interestingly, that brings me to Frank Emiller's question. And he says, I've read so many books, yet I am completely lost with anything above 4 units. How do I get past it? When you get it cycles back to the beginning of our conversation today. When you think of a 4 unit, when you get on Bigger Pockets, even when you get on my website, JustAskBEnWhy, the place where we are all likely starting. In multifamily, we're underwriting cash flow. We're thinking about it as a cash flow investment. This is the wrong approach for larger multifamily. Just like we talked about in the beginning of the webinar or Facebook Live. Anyhow, I guess it's a webinar, right? So the reason Sam and I are able to look at a deal, this one actually took a few minutes to think about because there were pieces of it that looked promising. So a couple of emails between myself and the broker went out, and we were able to kind of get the big picture. That big picture is a function of underwriting. The underwriting, people always forget. The underwriting is not about the numbers. Underwriting is about dynamics. Those dynamics are represented with numbers. What we're discovering here with those emails going back and forth between us and the broker is we're getting to the bottom of the dynamics present in this investment. But the entire time we're thinking about this, the entire half hour that it took to exchange the emails, Sam and I are thinking about the 13 pages in the underwriting, because we've done it so freaking many times that you start to see, you almost sense the direction of the numbers, how the numbers go. So to answer your question is, Frank, how do you get comfortable with above 4 units? You have to gain perspective on it, which is different from that of a 4 unit, first of all. And secondly, you just have to do it. You have to do it. You have to underwrite it. There's a reason you're comfortable with 4 units, because it's what you know. You got to get out of that comfort zone. The problem is, the bigger you go, the more exacerbated or amplified your mistakes become. So making a mistake in a fourplex might cost you $1,000. Making a mistake in 100 units might cost you 50. And that makes a whole lot of difference. So I think it's appropriate at this point to now invite you guys to the Phoenix Syndication Workshop that we're going to be holding in January. I don't know, most of you are probably aware, you've seen it on my timeline. I haven't started really reaching out. But today, I'm going to offer you that spreadsheet. Those, 10 or whatever pages of underwriting. I've never given it out. I've never sold it. I have no idea what it's worth because I have no desire to ever sell it. It's not for sale to anybody at the event. It's never going to be for sale. But today, I'm going to tell you that on Friday, there's an email that's going to go out to my entire list, which is about 10,000 people, in which I'm going to tell people that the first 50 registrations to our event are going to receive this underwriting spreadsheet for free. No additional charge. So the hurdle is very simple. The October 15th or the first 50 registrations. October 15th or first 50 registrations receive this spreadsheet.
So to give you some background on the event, it's a 2-day event, January 26th and 27th here in Phoenix.
I think I'm crazy, by the way. I'm like, I shouldn't be doing this because you're like, you guys are going to keep competing with me. Like, you're going to have some firepower. You're going to, this spreadsheet took years of trying to figure out how to get shit done.
Roman says it's about time.
Years. Do you know what I mean? Years. And I'm giving out, I don't know, I must be stupid. Anyhow, go ahead.
So 2 days, we'll dive into this. We'll actually have the spreadsheet. Someone seemed disappointed earlier we didn't have the spreadsheets. We will go see a property we recently closed on. You'll hear from professionals that we use, SEC attorney, broker, mortgage broker, property manager. Should be a great event, and you'll learn a lot.
So in the first day, which is Saturday, the entire day, Sam and I are going to be upstage. You're going to have a screen or 2 screens. We got a room for 150 people. So we're going to be up there. There's going to be spreadsheets up there on the screen. And we're going to be talking about this line item by line item, explaining to you guys exactly the underwriting methodology, why we do what we do, why we look at things the way we look at things. Okay? The whole thing. The whole thing. Okay? And then second day on Sunday, we have maybe for about 3 hours, we have 4 speakers. Aside for that, we have a bus tour to the property. And of course, the VIPs have a few extra things. We have a dinner Friday night for folks that register for VIP. And we have special seating for VIPs up front close. And then on Sunday afternoon after the event, we're doing a barbecue at Sam's house, which is now fully completed. So, yeah, Logan says, I'll take the spreadsheet. I've got a few words for you.
Says he wants what's in your head, though.
Well, come to the event, dude. Come to the event. I'll be up there telling you guys what's in my head. And the thing of it is that, look, underwriting is part science and part art. And the art portion of it comes from experience. You have to know how tenants behave. You have to know how their behavior interacts with property. You have to know what happens dynamically at the property. Okay? So we'll be there. It'll be a fun, good event. And, those of you who know me, I like to teach, and I don't really leave much out. You get everything I got. So, okay, October 15th is the cutoff, or first 50 registrations, whichever happens first. This Friday, the whole world is going to know this. But right now, you guys are the only ones who know. So you have, today's Tuesday, Wednesday, and Thursday to get yourself registered for the event without competing with everyone else. On Friday, I'm going to send this out to my list.
So to register, go to JustAskBEnWhy.com/Phoenix. If you just go to the website, I think what's the link at the top? Phoenix
something, Syndication Workshop something. www.JustAskBEnWhy JustAskBEnWhy.com, and it says Phoenix
Live 2019.
Live 2019. Phoenix Live 2019 at the top of the page. See you at the barbecue, Logan said. You're coming from Texas. He's just coming from
He's just coming for the barbecue and to talk to you.
He's just coming to the barbecue. All right, guys. Does anybody have any more questions? Otherwise, we're going to jump off.
Cool.
Going once. Going twice. Pleasure to be with you today. Hope to see you in Phoenix. Have a great day, guys. Bye-bye.
So does that show up on your
It should.
page?